You think you make financial decisions based on logic, based on numbers, based on what's best for you. You don't. Every time you walk into a bank, open a financial app, take out a loan, or sign a credit agreement, your brain is being quietly, systematically manipulated by people who have spent decades studying exactly how your mind works. Not to help you, to extract maximum value from you. The banking industry spends billions of dollars every single year on behavioral psychology research. Not to understand you as a customer, to understand you as a target. And the terrifying part? The weapons they use against you aren't complicated. They aren't hidden in small print or buried in complex financial instruments. They are hardwired into your brain. They were there before you ever opened your first bank account. And until you can name them, you cannot defend against them. Tonight we are going to name all 5. In the 1970s, 2 psychologists named Daniel Kahneman and Amos Tversky began a series of experiments that would eventually change our understanding of human decision-making forever. What they discovered was both simple and devastating. Human beings are not rational actors. We do not process financial information the way a calculator does, coldly, accurately, without bias. Instead, our brains use mental shortcuts, instincts, patterns inherited from ancestors who needed to make fast decisions to survive on a savanna, not slow, careful decisions about 30-year mortgage interest rates. These shortcuts are called cognitive biases, and in the context of basic survival, they served us well for hundreds of thousands of years. But in the context of modern banking and finance, they are open wounds. And the financial industry, with access to the same psychological research you never studied in school, found those wounds decades ago and built their entire business model around them. What I'm about to show you are the 5 most exploited cognitive biases in modern banking. Once you see how each one works and exactly how it's being used against you, every future financial decision you make will look completely different. Stay with me, because the 5th one is the one that controls everything else. The first weapon they use against you is called anchoring bias. Here is how it works. When the human brain encounters a number, any number, it immediately and unconsciously uses that number as a reference point for every evaluation that follows. This reference point is called an anchor. And once an anchor is set, it is extraordinarily difficult to think beyond it. Even when you know the anchor is arbitrary, even when you know it was placed there deliberately. Kahneman and Tversky demonstrated this in a famous experiment. They asked participants to spin a wheel that was rigged to land on either 10 or 65. Then they asked the participants to estimate the percentage of African countries in the United Nations. The people who spun 65 gave dramatically higher estimates than the people who spun 10. The random number had contaminated their thinking. A completely unrelated number had anchored their judgment. Now consider what happens every single time you walk into a bank to discuss a loan. The first thing the banker does is show you a number. Not the number that benefits you, the number that benefits them. They show you the original loan amount, the sticker price, the maximum credit limit, the highest interest rate tier. Whatever number creates the most favorable anchor for the conversation that follows. When they then offer you a slightly lower number, a reduced rate, a special term, a discounted fee, your brain doesn't evaluate that offer against an objective standard. It evaluates it against the anchor. And compared to the anchor, the offer feels like a win. You didn't get a good deal. You got a manipulated perception of a good deal. This is why car dealerships always show you the most expensive model first. This is why credit card companies display your maximum credit limit prominently, rather than your current balance. This is why banks publish their standard interest rates before telling you the rate they're actually offering you. The anchor is never accidental. It is always chosen deliberately to make whatever comes next feel like a relief. The defense. Before you enter any financial negotiation, research the actual market rate independently. Arrive with your own anchor. Never let their first number be the first number in your head. The second bias is the most powerful psychological force in all of human financial behavior. It is called loss aversion. Here is the principle, proven across hundreds of studies. The pain of losing something is psychologically approximately twice as powerful as the pleasure of gaining the equivalent thing. Read that again. Losing $100 feels roughly twice as bad as gaining $100 feels good. The emotions are not symmetrical. Loss hits harder. Loss lingers longer. Loss motivates behavior far more urgently than equivalent gain. Evolution built this into us for good reason. An organism that feared losing its food supply more than it desired finding new food was more likely to survive. Caution kept our ancestors alive. But in the financial system designed by people who understand this bias intimately, loss aversion is a remote control for your behavior. Watch how it appears everywhere once you know what to look for. Limited time offer. This rate expires Friday. They are not creating urgency around a gain. They are creating fear around a loss. The loss of the offer. The loss of the opportunity. Your brain responds to that threat the way it would respond to a predator, with urgency, with reduced deliberation, with action before thinking. You are currently missing out on 2.4% interest by keeping your money in your current account. Not, you could gain 2.4%. You are missing out. You are losing. Every day you don't act, you lose more. The language is surgical. Overdraft protection. Don't lose access to funds when you need them most. The product they're selling you is a fee-generating service. But they're not selling it as a fee. They're selling it as protection from loss. Protection from the devastating moment you are declined when you need money. That fear, that vivid imagined loss, makes you sign up for something that costs you money every time you use it. Insurance products, early repayment penalties, annual fee credit cards with benefits you can't afford to lose. Minimum balance requirements framed as protecting your account status. Every single one of these is loss aversion being harvested. The defense. Every time you feel urgency in a financial decision, stop. That urgency is almost always manufactured. Ask yourself, am I moving toward something genuinely good, or am I running away from a loss that may not be real? Slow down. The offer that expires Friday will have an equivalent offer on Monday. The loss they're describing is almost never as catastrophic as they're making it feel. The third bias is the one that has kept more people poor for more generations than perhaps any other force in personal finance. It is called present bias, and it is brutally simple. Human beings systematically overvalue things available right now compared to things available in the future, even when the future option is objectively, mathematically superior. If I offer you $100 today, or $150 in 30 days, the rational choice is obvious. Wait 30 days. Collect $50 extra for doing nothing. But studies consistently show that a significant majority of people choose the smaller amount now. The present pulls with a gravitational force that arithmetic cannot easily overcome. This was adaptive for our ancestors. An animal that ate the food available now rather than waiting for potentially better food tomorrow survived more reliably. Delayed gratification is an evolutionarily recent behavior. The brain resists it, and the consumer credit industry was built on this exact resistance. Buy now, pay later. 3 words that together represent perhaps the most perfectly engineered exploitation of a cognitive bias in the history of commerce. The pleasure is now. The television is in your living room now. The vacation happened. The shoes are on your feet now. The present self experiences the reward fully and immediately. The cost is future. The payments begin next month. The interest accumulates in the abstract future. The financial damage happens to a version of you that doesn't yet exist, and whose suffering your present self cannot fully feel or imagine. Banks and credit companies understand this asymmetry completely. That is why every consumer credit product is designed to maximize present pleasure and push cost as far into the future as possible. 0% interest for 12 months. No payments until next year. Minimum monthly payments so small they feel almost irrelevant. They are not being generous. They are feeding your present bias with one hand and building a debt structure with the other that your future self will spend years repaying, with interest that compounds relentlessly while your present self has long since forgotten the original purchase. Credit card minimum payments are perhaps the purest expression of this exploitation. If you have a $5,000 credit card balance and you make only minimum payments, in many cases you will spend more than a decade repaying it and pay more in interest than you originally borrowed. The bank designed the minimum payment specifically to be small enough that your present self will choose it, and large enough only to keep you in debt for as long as possible. The defense. When evaluating any credit product, ignore the present completely. Calculate only the total cost. Not the monthly payment, not the first year cost. The total amount you will pay from the first payment to the last. That number, written on paper in front of you, is the only number that matters. Your present brain will resist doing this calculation. Do it anyway. The fourth bias is one that operates so quietly most people have never heard of it, yet it influences nearly every spending and saving decision you make. It is called the denomination effect. Here is what it describes. People treat money differently based on its physical or psychological form, even when the underlying value is identical. A person with a $50 bill in their pocket spends less than a person with 50 individual dollar bills. The total amount is the same. The purchasing power is identical. But the psychological experience of spending is completely different. Breaking a large bill feels like a loss. Spending small bills feels almost frictionless. This effect extends far beyond physical cash. Think about how you experience your bank account balance. The number sitting in your account, let's say $4,000, feels like a single thing, a reserve, a buffer. Breaking into it for a purchase feels like damaging something whole. This is the denomination effect protecting your savings through psychological friction. Now watch how banks systematically dismantle that friction. Contactless payments, mobile banking apps, one-click purchasing, automatic subscription renewals. All of these technologies share one fundamental design goal: to remove the psychological experience of spending money. When you tap your phone to pay for something, no bill changes hands. No coins are counted. The number in your app decreases by an amount that registers almost subconsciously. The denomination effect, your brain's natural resistance to breaking money apart, is completely bypassed. The friction is gone. This is not a coincidence of technological convenience. This is intentional friction removal, engineered by people who know that every point of friction in the spending process is a moment where you might reconsider. Think about subscription services: Netflix, Spotify, gym memberships, software subscriptions. These are specifically priced at amounts small enough that your brain never experiences them as significant denomination breaks. $9.99 per month doesn't feel like $120 per year, which is what it actually costs. The monthly denomination makes the spending almost invisible. Banks compound this by presenting your account as a single running total, rather than showing you the cumulative cost of your subscriptions, your fees, your interest payments. If your bank statement showed you not your current balance, but your total outflow by category over the past 12 months, the number for bank fees alone would likely shock you. The defense. Periodically force yourself to confront the annual version of every recurring cost. Take every monthly subscription, every automatic payment, every small recurring fee, and multiply it by 12. Write the annual number down. That is what it actually costs. Your brain needs to see the large denomination to feel the appropriate weight. The fifth bias is the deepest, the most sophisticated, and in many ways the most insidious, because it doesn't make you feel manipulated at all. It makes you feel powerful. It is called the illusion of control, and it describes the human tendency to believe we have more influence over outcomes than we actually do, particularly when those outcomes involve elements of chance, complexity, or systems we don't fully understand. In 1975, psychologist Ellen Langer demonstrated this in a simple experiment. She found that people became significantly more confident in lottery outcomes when they were allowed to choose their own lottery ticket versus being assigned one, even though both tickets had identical odds of winning. The act of choosing created a psychological sense of control over a purely random outcome. The illusion was complete. Now consider the modern banking and financial services industry. You have an app. It has charts. It shows you your spending by category, your balance trending over time, your financial health score. You can set savings goals and watch progress bars fill. You can allocate percentages and customize notifications. You can choose from dozens of account types, dozens of credit card variants, dozens of investment product configurations. All of this choice, all of this interaction, creates a powerful illusion that you are in control of your financial outcomes. You are not. The interest rate on your savings was set by a central bank you have no influence over. The fee structure on your account was designed by a legal and financial team whose job is to maximize revenue from you. The investment products available to you through your bank are specifically curated to be the ones that generate the most fee income for the institution, not the ones most likely to generate wealth for you. The app is not a control panel. It is a dashboard designed to make you feel like a pilot while someone else flies the plane. This illusion of control has a second, more dangerous dimension in the context of investing. When people feel in control of their financial decisions, they become overconfident. They trade more frequently. They deviate from sound long-term strategy. They make reactive decisions based on short-term information, buying when prices are high, because everything feels exciting and they feel in control, selling when prices drop because the loss aversion bias kicks in, and the illusion of control tells them they can time the market. Every single one of these behaviors generates fee income for financial institutions. Every trade on a brokerage platform generates a transaction fee or a spread. Every product switch generates commission. Every reactive decision made under the illusion of control is a revenue event for the system. The truly wealthy understand this. That is why they don't actively trade. That is why they don't constantly reorganize their financial products. That is why the most sophisticated investors in the world operate on the simplest possible systems. Because they understand that the feeling of doing more, the feeling of being in control, is itself a trap. The defense. Recognize that complexity in financial products almost always benefits the seller, not the buyer. The more moving parts a financial product has, the more opportunities it contains to extract value from you. Simplicity is not ignorance. Simplicity is sophistication. The wealthiest people on earth keep their financial structures simple, and they change them rarely. Not because they lack the intelligence to manage complexity, but because they understand that the system profits most from your activity, not your inactivity. Here is what makes these 5 biases truly dangerous. They don't operate in isolation. The banking industry doesn't deploy one bias at a time. It deploys all 5 simultaneously in a carefully orchestrated sequence designed to move you from awareness of a product to commitment to that product before your rational mind has had adequate time to intervene. Watch how a single credit card sales interaction uses all 5. You walk into a bank. The banker shows you a card with a $20,000 credit limit, the anchor. Before you've processed that number, he tells you this offer is only available until end of month. Loss aversion activated. He explains how you can start enjoying the benefits immediately with no payments for 6 months. Present bias fed. He shows you the app where you can track your rewards points and manage your account. Illusion of control created. And the monthly fee? Just $14.99 per month. The denomination effect makes it feel like almost nothing. 5 biases, 1 conversation. You sign. And the bank has acquired a customer whose behavior over the next several years will generate predictable, reliable revenue, because the product was engineered around how your mind actually works, not how you think it works. Knowing these 5 biases does not make you immune to them. That is the uncomfortable truth I need to leave you with. These are not logical errors you can simply correct by deciding to think differently. They are structural features of human cognition, built over hundreds of thousands of years of evolution. They will always be present. They will always exert pressure. But awareness changes the game. When you feel urgency in a financial decision, you now know that urgency is likely manufactured loss aversion. When a product feels affordable because the monthly cost seems small, you now know the denomination effect is hiding the true annual cost from you. When you feel in control because you have a beautifully designed financial app, you now know that feeling of control may be the most expensive illusion in the room. Name the bias. Slow down. Calculate the real number. And remember, every time you feel an emotion in a financial context, somewhere a behavioral economist who works for a bank is doing their job correctly. Now you know their tools. Use that knowledge. Subscribe, because every video on this channel is one more layer of the architecture they built around your financial life, pulled back into the light. And if this video made you see something differently, leave a comment telling me which of the 5 biases you've already fallen for without knowing it. Because I guarantee every single person watching has been hit by at least 3 of them.